Welcome. My name is Christopher Aaron. I'm the founder of iGold Advisor and Elite Private Placements. iGold Advisor, we have a flagship research service that covers all aspects of the precious metals markets. And then in Elite Private Placements, we have a group of high net worth investors, and we come together and we finance these mining companies like the ones that have just been talking to you recently. We pool our capital together, and because of that, we're able to go out and negotiate better terms with these companies. And I mean, I love all these companies, but you just have to be really careful as an investor because everyone has a story to sell you. The discipline that I focus on is a little bit different. I focus on the price of the asset class in question. So in Elite Private Placements, we come together and we negotiate better terms on these investments. I hope you'll consider joining us. I started my investment career in the crash of 2008. I mean, literally right before the crash of 2008 is when I started investing in gold. I was 28 at the time, and I was listening to a lot of well-meaning individuals who had incredibly brilliant sounding stories to tell about the problems in the global economy, the problems with fiat currency, problems with the Federal Reserve. Fantastic. It all made sense. I put all my money into gold and gold miners because it made sense. And what happened immediately after I invested? Gold fell by 25%, the stock market fell by 31%, silver fell more than the stock market by 52%. And this is not a typo. In 6 months, the gold miners as a whole, and these are the large cap gold miners, the gold miners fell by 70%. A lot of the juniors fell by 90%. So I cut my teeth. My first real lesson in investing was if there's these individuals who could be so right on the problems with the global economy, but they could get the outcomes so wrong, why am I listening to them? And isn't there a better way to analyze the markets? The fourth turning for gold, what we are going to focus on here is price, the price analysis of gold, key ratios, and how this signal is setting up. And by the way, before I go any further, I'm going to say thanks to God, because we are living through a cycle that has not happened in over 50 years in these markets. And I have clients, a number of clients out here who are coming up to me every day and telling me they're retiring based on this move. They can stop working, they can pursue their passions, they can buy a house, they can pay off their mortgage. This is literally happening right now. So we have to give thanks where thanks is due. We're looking at a chart of the Dow Jones Industrial Average compared to the price of gold going back for 130 years. And I'm not cherry picking any data. This is when the Dow Jones started, 1897. And of course, we're looking at it compared to the price of gold. The higher that this chart goes, the better that the Dow is doing. The lower that this chart goes, the better that gold is doing. And so you can see that we're somewhere right in the middle, right? We're sort of in the middle. Actually, on the log scale, we're kind of still on the upper side. This is still sort of Dow doing better as a net sum over the last couple of decades. Now, the amazing thing about the relationship between the US stock market and gold is that it moves in these fantastic multi-generational cycles. The first cycle, as I call it, the first turning, was after the Roaring 20s in the 1920s, and you had a lot of speculation. You had the railroad boom, electrical. Railroads were earlier. You had electrical, you had automobiles, airplanes, right? Roaring 20s. You get some speculative enthusiasm coming in there, and what happens? 1929, the crash of 1929, leading to the Great Depression, the Dow Jones fell by 90% in 3 years. 90%. Compared to the price of gold. Of course, gold was fixed. It was on the dollar standard, or the dollar was on the gold standard, however we want to say it. 90% decline in the value of the Dow versus gold in 3 years. We have the Great Depression, we have World War II, we have the recovery out of World War II, technological boom into the 1960s, and then what? We have the second turning of this ratio, the second turning in 1966. 1966 to 1980, the Dow Jones loses 96% of its value versus gold. A lot of wealth was destroyed, a lot of wealth was created, depending on which side of this equation you were on. We have the Vietnam War going on in there, we have guns and butter, we have the abolishment of the Bretton Woods Accords in 1971 under President Nixon. 1980, we get into the PC revolution. We have the internet, we have cell phones, we have CD players, right? And that leads to what? In the year 2000, the NASDAQ bubble. The most overvalued that the stock market has been relative to gold ever, including today. Despite cryptocurrency, despite the AI boom, the 2000 peak was the most overvalued that the stock market has been. The third turning in the year 2002 resulted in what? An 86% decline in 10 years for the stock market. So, here we are. There have been 3 turnings, and we are seeing the evidence. This is not a story. You can see it on the chart right here. You can see the data. We have a 45-year rising trend in favor of the Dow, and for people who say, well, why are you using the Dow? You should use the S&P 500 or the Russell 5000. They track with 98% correlation. There's no need to use the other one. The Dow is perfectly good. We have a longer data set with the Dow. We're seeing the 4th breakdown in the Dow versus gold right now. Literally today. We're seeing it happen. If we were to average out the other 3 cycles in the Dow versus gold, we will come up with an astonishing figure for what should be happening over the next several years. And some people might say, well, you only have 3 data points to refer to. The only 3. There's no more. I'm not cherry picking the data here. If we average out the previous 3 cycles, we will be looking at a net sum of a 90% decline, once again, in the Dow versus gold in 9 years. And that 9 years was from the peak, which was a few years ago. So we're already well into this cycle. So this is the 4th turning. It's happening. I mean, the fact that gold is above $5,000 per ounce, silver is, up to 100, 110. I mean, this is it. It is happening in front of our eyes. And if we just calculate the number, don't get too concerned with the numbers here. I'll explain what this means. Pay attention to the motion of the cycles, the breakdowns in the cycles. That's what you want to pay attention to. But the math is going to calculate out, if we take the average, it's going to calculate out to 2.2 is where this ratio should get to over the coming years. Why is this happening? We have 2 completely separate sets of fundamentals impacting the global markets right now, basically for the first time in history. We have debt levels that have skyrocketed in the United States and around the world, debt currently above where it was in the largest global financial conflict, global military conflict, I should say, World War II, in human history. Why is the debt so high right now? I mean, we haven't fought off the Nazi and the Axis powers for the last 7 years, but what is going on with this debt situation? So we have that going on, but we also have a genuine amount of technological progress happening, right? We have AI going on, we have medical advances, we have nanotechnology, we have the beginnings of space exploration. And so these 2 separate groups of investors are choosing to express their belief as to which of these themes is more important by one asset class versus the other asset class. All of us here who understand the problems with debt and fiat currency and central banking are saying gold, precious metals, mining stocks, hard assets. The investors that are blind to these themes, cryptocurrencies, AI stocks, meme stocks, et cetera, et cetera. And we have been in a situation where the sum of humanity has not known which one of these is more important for the last 10 years. Not just me. Here's the proof. Look at this. 10 years. This is the oldest dated stock market index in the United States, and there's the 5,000-year-old store of wealth. They're the same. 1/1, the same for 10 years. This has never happened before. Not in 130 years of the Dow. This is the chart that I showed 1 year ago today at my talk. Ready to fast forward 1 year? Boom. Look at that. Look at gold distancing itself from the Dow. I was agnostic a year ago. I was saying, let the data prove itself to me. That's my philosophy. To go back to my experience in the crash of 2008, when the storytellers had interesting sounding stories to sell me, but they got the outcome wrong, I stay agnostic until the charts show me. And right now we have this chart is showing us. So we just looked at it 1/1, and now we're looking at, once again, as a ratio. If we take the average of the previous cycles, I said it's a 90% decline in 9 years, it's going to lead to a level of 2.2. Wait till you see what this actually means for the gold price. You might say, well, that's impossible. It can never go that low. I mean, that's absurd. It's happened 3 other times. I'm not coming up with a scenario here that is out of the blue. This has happened 3 other times. We see the trend break. We see the fourth turning in front of our eyes. This is coming. This happens every time this ratio breaks in favor of gold. Get ready for it. Here are the numbers. Current levels, Dow to gold is 10. Dow is approximately 50,000. I'm using round numbers here. Gold approximately 5,000. We can talk about 3 different scenarios. Remember, this is a ratio chart. In the Great Depression, the Dow crashed, and gold was eventually revalued higher. If we were to see a scenario like that, the deflationary collapse, scenario A in red, we'd be talking about the Dow losing 80% of its value, but gold actually falling simultaneously. This is the hard thing to believe. Gold can fall. We looked at it in the global financial crisis. Gold can fall during a financial crisis. Yet, that ratio would still get to 2.2 even in the deflationary collapse. If we're talking about the stagflation or the inflationary spiral, look at what the numbers come out to be. 2.2 is Dow 30,000 and gold 13,600. The inflationary spiral, where the Dow actually stays elevated, gold goes to 31,000. Again, you're going to say that's impossible, but what I'm saying is that this level has been hit 3 other times in history, and either way, no matter which way this plays out, they all lead to the same net gain for gold relative to the Dow. It's a 400% gain for gold relative to the Dow, or an 80% collapse in the Dow relative to gold. It all works out to the same number. Same amount of purchasing power increase by gold is coming. I would prefer to see the stagflation or the inflationary scenario because that's going to be better for silver. We'll talk about silver in a moment. Right now, let's talk about silver. How high? How high is it going to go? This is the other great chart that we have to sort of guide us in this. By the way, I'm talking about the next handful of years here, the next 2, 3, 4, 5 years. This is not a generational move. This is going to happen in all of our lifetimes. We can see the relationship between gold and silver. There's a deflationary collapse zone. The number of ounces of silver required to purchase 1 ounce of gold, World War II, COVID. We can see there's an inflationary zone down here at 15, Vietnam, the end of the gold standard, the end of the 1970s bull market in gold. Federal Reserve had to jack up interest rates to 17% on short-term debt in the 1970s. And then we can see there's this zone right in the middle. It's called the stagflation zone. It's a little bit of each, right? It's a weakness in the general economy, but inflation at the same time. Mainstream economists would say this is impossible. It's not impossible. I expect the gold to silver ratio to be going to 38 Look at this trend line that we have coming out of the 1980 lows up through the 2011 low. That was the last major peak in precious metals. That comes in at 38, and that puts us pretty much in the stagflation or the inflation, somewhere in between. I think in the modern political paradigm where politicians only keep their jobs if they promise their constituents goodies from the public treasury, there is no political will to cut funding. There's no political will to rein in the spending. Politicians end up with riots and people showing up at their houses with pitchforks in the middle of the night if they do that. Why would they do that? They're going to print the money. This is going to end up stagflation or inflation. And so if we look at this, the same projections, and let's talk about that middle scenario, stagflation. We just talked about the Dow losing 40%, gold gaining 175%. These are all data points from the past that have happened 3 other times in the last 130 years. And we just put the gold to silver ratio at 38. It's almost there. It's closing in on the 40s right now as we speak. That's silver $350. This is the exact same level that was hit, the gold to silver ratio, the exact same level that was hit in 2011 between gold and silver. People are going to think I've taken something funny before this talk, but I have not. This is the level that it hit in 2011 between gold and silver. So that's where I think this is going. Now, we have sort of just a few minutes here. I want to give a few stocks, a few takeaways. These are companies that I'm investing in and my premium subscribers in our elite private placements group. We are investing in these companies. They're not paying me a cent to say this. That's not my business model. My business model is I go out and I negotiate with these companies for better terms, and then I put my own money into these companies. We pool our money together. We get really good terms on our investments. So I'm just sharing with you the research on the companies that I am investing in. My investors as well. Providence Gold is PAU. This is my personal biggest position. Of all the positions that I have, this is my largest one. I'm calling this my most upside potential stock, Providence PAU in Canada. It's a small company, still 40 million market cap USD. The reason why I'm doing this is because if you understand the ramifications for the fourth turning in the Dow to gold ratio, you're going to want some action points. You're going to want, hey, what are some ways to leverage this theme? And that's what we're doing here. Providence has 2 million ounces of gold at El Dorado in a historical resource estimate down to 100 meters. But last year, they found visible gold 3 times below the historical estimate. Market shot up, stock nearly quadrupled on that news alone. And now they're finding gold 800 meters west of the historical estimate. Here's a map. Here's the historical estimates, that 2 million ounces. They're finding gold 3 times deeper and kilometers away. And then you have this 5x of a new position. And it's just a question, what is at that land package? There's a mine that was just permitted. This is in Eastern Oregon. There's a mine that was permitted. And so this is a very friendly jurisdiction for mining. This is my single largest position. My second largest position is Sirios Resources. They are here. They have a booth here. SOI in Canada. 55 million market cap. They've got 3 million ounces of gold up in Quebec, Canada. And they have made a new acquisition of OVI Mining, which brings Sean Rosen. Wait till you hear about this. Sean Rosen was responsible for developing the Canadian Malartic mine. This is the second largest producing gold mine in Canada today. They've brought him onto the board of directors. And we can see that they are 15 kilometers away from a producing large gold mine, producing over 150,000 ounces per year. There's the line of sight. That's why Sirios is my second largest personal position. The fourth turning for gold is happening in front of our eyes. This is going to be the fourth major time that there is this generational transfer of wealth from mainstream stockholders to hard asset holders. And then the question is, how do we leverage that theme? Physical gold is going to do well. Silver is going to do even better over the long run. A lot of these mining stocks are going to change investors' lives. And so that is what we are doing here. Thank you for being here and listening.